Everyone else out there is making trading strategies sound like rocket science. They throw around complex terminology, overwhelming charts, and explanations that would confuse even seasoned traders. But here's what I believe. If you can't explain something simply, you don't understand it well enough yourself. That's exactly why I'm going to break down all the essential trading strategies in a way that's so clear your 90-year-old grandmother could master them in just 5 minutes. I'm talking about Fibonacci retracements, Elliott wave theory, harmonic patterns, fair value gaps, market structure analysis, the whole arsenal that professional traders use. And trust me, the last strategy I'll show you is something you've definitely never heard of before, and it's going to absolutely blow your mind. Now, if you're already an experienced trader, don't click away just yet. This comprehensive review is going to be incredibly valuable for you too. Sometimes we get so caught up in the complexity that we forget the fundamentals that actually make money. Plus, I guarantee you'll pick up at least a few techniques you haven't seen before, or remember something crucial you might have overlooked. Let's get straight to it. Candlestick patterns. Every single candle on your chart tells a story about the battle between buyers and sellers. When you learn to read these price stories, you'll understand exactly what the market is trying to tell you about its next move. This ancient Japanese technique allows you to predict future price behavior by studying the shapes and formations of individual candles. The most powerful signals include engulfing formations that show overwhelming momentum in one direction, hammer and shooting star patterns that reveal price rejection through their distinctive long shadows, and doji formations that indicate market indecision when buyers and sellers reach a standoff. Each candlestick formation reveals the market's inner psychology and positions you ahead of the crowd who can't read these subtle price signals. Support and resistance. These fundamental price zones represent horizontal levels, where price has previously bounced and might bounce again in the future. When a level sits below current market price, we identify it as support, a potential buying zone when price approaches. When a level sits above current price, we call it resistance, a potential selling zone when price reaches that area. Trend lines. These diagonal reference lines form during trending market conditions and help you identify the overall price direction. An ascending trend line indicates bullish market sentiment, while a descending trend line reveals bearish sentiment. Just like horizontal support and resistance, trend lines create excellent entry opportunities. When price pulls back to touch an upward trend line, it often provides an ideal buying opportunity within the larger upward movement. Momentum indicators and trend indicators. These analytical tools measure both trend direction and strength, performing optimally during strong trending market conditions. Key momentum tools include MACD, where upward line crossovers signal bullish trends, while downward crossovers indicate bearish trends. Moving averages work by showing that price above the average suggests bullish conditions, while price below suggests bearish conditions. Parabolic SAR displays dots. Dots positioned below price indicate bullish trends, while dots above price indicate bearish trends. Supertrend provides clear visual signals, with green indicating bullish conditions and red indicating bearish conditions. Oscillators. These tools measure price strength relative to recent ranges and work best during sideways or choppy market conditions. RSI stands out as a premier oscillator. When the line enters oversold territory, it suggests potential upward reversals. When it reaches overbought territory, it suggests potential downward reversals. Stochastic employs two lines. When both lines reach oversold levels, it signals potential upward reversals. When both lines reach overbought levels, it signals potential downward reversals. These lines can also cross each other to generate additional price direction signals. Volume indicators. These tools reveal the power behind price movements by analyzing trading volume data. Key volume tools include price volume, which shows volume for each individual candle. Longer volume bars indicate higher trading activity. Volume-weighted average price calculates the relationship between an asset's price and its total trading volume. You can trade this indicator like a moving average or use it as dynamic support and resistance levels. Volume profile presents volume data horizontally across different price levels, creating key zones for potential trade entries. Breakout patterns. Picture this scenario. Price gets trapped in a tight range, bouncing back and forth like a ping pong ball. Then suddenly, boom! It explodes through one side of that range with tremendous force. That explosive move is what we call a breakout. These powerful movements typically happen after the market has been stuck in what traders call a consolidation phase. Think of it like a spring being compressed. The longer it stays compressed, the more explosive the eventual release. Let me paint you a picture. Watch how price moves sideways in this tight range, going absolutely nowhere. Then observe what happens next. It bursts through the bottom with incredible momentum. This dramatic price explosion creates massive profit opportunities for those who know what to look for. Smart traders use recognizable chart formations to spot these explosive moves before they happen. The most reliable patterns include wedge formations, triangle setups, and rectangular consolidations. Each pattern tells you a unique story about where price wants to go next. Reversal patterns. Sometimes the market completely changes its mind and decides to head in the totally opposite direction from where it was going. These dramatic U-turns create what we call reversal patterns, and they're absolute gold mines for traders who can spot them early. Here's what separates the professionals from everyone else. They can recognize specific chart formations that signal these dramatic direction changes before they actually happen. The most powerful reversal signals include double peak and valley formations, triple peak and valley formations, the famous head and shoulders setup, and those beautiful cup and handle formations. Each formation has its own unique fingerprint and gives you clear warning signs that the market is about to flip directions. Master these patterns and you'll never get caught on the wrong side of a major reversal again. Fibonacci retracements. This powerful tool creates horizontal reference lines using those mathematical Fibonacci sequences you might remember from school. These magical numbers transform into critical price zones, where the market often decides to change direction. Here's your step-by-step process. Start by spotting the highest peak and lowest value on your chart during a significant price movement. Once you've identified these two extreme points, simply connect them using the Fibonacci tool by dragging from the bottom to the top. Now watch the market for the pullback. Here's where it gets exciting. Price will often bounce right off the 0.382 level like it hit an invisible wall. This particular zone has an incredible record for catching reversals, which is why smart money always watches it closely. When you see price approach that 0.382 zone, that's your moment to consider a buy opportunity. But remember, the market isn't always predictable, so price might also react at the other Fibonacci levels. That's why professional traders stack multiple confirmation signals before pulling the trigger on any trade. Market structure. This analysis examines market behavior patterns and price flow characteristics. Upward trending structures show price creating successively higher peaks and valleys. Downward trending structures show price creating successively lower peaks and valleys. Break of structure. This occurs when price penetrates the previous significant peak during a trending move. For instance, during an upward trend creating higher peaks and valleys, breaking above the previous peak constitutes a break of structure. Change of character. This happens when price violates the previous structural pattern during a trend, often signaling trend reversal. For example, during an upward trend creating higher peaks and valleys, if price breaks below the previous valley to create a lower valley, this represents a change of character. Supply and demand and order blocks. Also known as order blocks, these represent price zones where significant market movements originated. When price rockets upward from a specific level, that zone becomes a demand area. When price plunges downward from a level, that zone becomes a supply area. These zones function similarly to traditional support and resistance, serving as key reference levels for potential trade entries. Fair value gap. These are hidden profit zones that most traders completely miss. A fair value gap appears when a single candle creates a significant price jump due to extreme buying or selling imbalance in the market. Here's your hunting strategy. Search for candles with unusually large bodies. These indicate powerful momentum shifts. Next, identify the empty space between the previous candle shadow and the following candle shadow, then mark this gap with a rectangle. This marked zone becomes a price magnet where the market often returns later. It's as if the market left unfinished business at that level, and professional traders know that price frequently revisits these gaps to fill them before continuing the original move. Divergence. Divergence occurs when your indicator shows opposite signals compared to actual price movement. This contradiction often provides early warning signs that the current trend might be losing steam and preparing to reverse. You can spot divergences across multiple indicators using MACD, stochastic, and RSI. Here's a practical example using MACD. Imagine price creating higher peaks, which appears bullish, but the MACD indicator simultaneously creates lower peaks, which appears bearish. This contradiction creates bearish divergence, warning you that price might reverse downward, creating a potential short selling opportunity. Dynamic support and resistance. This advanced concept works similarly to traditional horizontal levels, but instead of using fixed lines, it employs moving indicators like moving averages to create dynamic price zones that adjust with market movement. Elliott wave. This fascinating market theory reveals that price movements follow a predictable rhythm, 5 waves in the main direction, followed by 3 corrective waves in the opposite direction. It's like the market's natural heartbeat, and once you understand this rhythm, you can anticipate where price is heading next. The beauty of this approach lies in labeling each wave movement as 1, 2, 3, 4, 5, followed by ABC. But here's where it gets technical. There are 3 critical rules that must be satisfied for any legitimate Elliott wave count. The second wave can never exceed the length of the first wave, and typically retraces to around the 0.618 Fibonacci zone. The third wave must be the strongest and longest among waves 1, 3, and 5. The fourth wave needs to stay above the peak of wave 1 and usually retraces to approximately the 0.382 Fibonacci level. Look at this practical example. Notice how the price structure resembles a developing 1, 2, 3 Elliott wave sequence. Using wave theory principles, we know that wave 4 typically pulls back to the 0.382 Fibonacci area before the final upward surge. This creates a perfect buy entry opportunity right at that pullback level. Harmonic patterns. These sophisticated price formations follow precise mathematical relationships based on Fibonacci ratios. When you master harmonic patterns, you can predict future price movements with remarkable precision using these geometric price structures. Take the bullish bat formation as a perfect example. This pattern develops when price creates 4 distinct movements that form an M-shaped structure. Each turning point gets labeled as X, A, B, C, and D, with each point requiring specific mathematical relationships. The X to B measurement must fall within the 0.382 to 0.5 range. The A to C relationship needs to stay between 0.382 and 0.886. Similar mathematical requirements apply to all the other measurement points within the pattern. You can apply these precise mathematical rules to real market movements. When you spot price forming 4 distinct turning points, use harmonic pattern analysis tools to verify whether the formation meets the required mathematical criteria. If the measurements align perfectly, you can enter positions based on the completed harmonic structure. Multiple harmonic formations exist in the markets, with butterfly, bat, and crab patterns being the most reliable, each having unique mathematical measurement requirements. Gann fan and Gann angles. This advanced tool creates multiple diagonal lines spreading at various angles from a central point. These angular lines serve as potential price levels and help measure trend strength characteristics. Price movement along steeper angles indicates powerful trend momentum, while movement along gentler angles suggests weaker trend strength. The setup process requires specific steps. Access your settings and activate the Lock Price to Bar Ratio option. Identify a significant market range by marking the lowest valley and highest peak. Draw a vertical line at the range beginning. Select the Trend Angle tool and establish a 45-degree measurement. Finally, position the Gann fan tool at that 45-degree reference point. Heikin Ashi. This incredible indicator completely replaces your regular candlestick chart with a much smoother, cleaner version that filters out most of the market noise. When you switch to Heikin Ashi, you'll immediately notice how much easier it becomes to identify the true trend direction. The system works beautifully simple. Green Heikin Ashi candles signal that bulls are in control and price is trending upward. Red Heikin Ashi candles indicate that bears have taken control and price is trending downward. Here's the secret weapon. The actual size of each candle body tells you exactly how strong that trend momentum is. Bigger bodies mean stronger trends. Remember that Heikin Ashi serves as a trend analysis tool rather than showing exact market prices, but for identifying clean trend direction, it's absolutely revolutionary. Renko. Renko charts revolutionize how you view price action by eliminating the time element completely. Instead of forming new candles based on time intervals like traditional charts, Renko creates new blocks based purely on price movement magnitude. Here's how this game-changing system works. Set your Renko to create a new block for every 1% price movement. This means each block represents exactly 1% of price change, regardless of how long it takes to achieve that movement. You can customize these percentage settings through the indicator parameters to match your specific trading approach. Traders love Renko charts because they eliminate market noise and reveal crystal clear trend patterns. Green Renko blocks indicate upward price momentum, while red blocks signal downward movement. Keep in mind that Renko functions as a trend analysis tool and doesn't reflect actual market pricing. Moon phases. This might sound unusual, but lunar cycle analysis has gained serious attention among traders who study market psychology. The concept suggests that moon phases correlate with human emotional patterns, which can influence collective market behavior. Moon phase traders observe that specific lunar cycles tend to coincide with certain market tendencies. New moon periods often align with bullish market sentiment, while full moon phases frequently coincide with bearish market behavior. In modern trading, this approach serves primarily as an additional confirmation tool used alongside conventional technical analysis methods. If this video was helpful, hit that like button and write in the comments what your favorite strategy is. See you guys in the next video.